This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We are hosted by me, Benjamin Felix, Chief Investment Officer, and Cameron Passmore, Chief Executive Officer at PWL Capital.
Welcome to episode 378. And Ben, I got to hand it to you. Another week, another great guest. And it's so much fun to dive into financial history and how, sometimes what's the old saying? It may not be the same tune, but it kind of rhymes the same way.
Yeah.
So this week's guest, you found Mark Higgins, who joined us. And wow, what a great conversation and a real candid take on a lot of things that are happening in the industry these days. So tell us the backstory.
Well, the backstory is that just a mutual contact that Mark and I have told me that I've got to go look at his stuff. And I went and looked him up, and between his book, his writing, he's done some other podcasts, but not a ton. And he's done a few things for the CFA Institute. I was like, oh man, like he's just a perfect guest for our podcast because he's got a great historical perspective, which, as listeners know, we thoroughly enjoy. And he's also got some very strong but well-founded opinions on the big boom that we've seen in recent history in private asset classes like private equity and private credit, venture capital. So that's all interesting. And then in a professional capacity, he works with institutional clients at IFA, which is Mark Hebner's firm. People may remember Mark Hebner from back in episode 116. So you add all that stuff up together, the deep historical perspective, and the research that he did for his book, which I'll say more about in a second, and his work with institutional clients. He's just got such great, real perspectives. Well, he's got the historical perspective and then also the practical, like this is what people are doing, this is why they're doing it perspective. So as soon as I figured out what he had going on, I was like, oh man, we have to get him on as a guest, and here we are. That's kind of the backstory.
Awesome. So Mark is a senior vice president for IFA Institutional. So he works with, he tells us this in the episode, works with institutional plans such as endowments and foundations, but he also works with some high net worth clients. And interesting contrast in convincing different types of clients to invest in index funds or not, and the challenges around that. I thought that was really interesting.
Oh yeah, his comments on the difference between talking to a high net worth retail investor and an institutional investor with an investment committee. Just how the relative responsiveness to the concept of index funds for those two groups, which I've seen personally, and hearing him talk about it from his experience was super interesting.
Yeah.
Mark is also the author of the book Investing in U.S. Financial History, Understanding the Past to Forecast the Future. So this book recounts the financial history of the United States, starting with the innovative financial programs of Alexander Hamilton, who Mark talks about as sort of a very important historical figure for the U.S. financial system specifically, in 1790. And then the book ends with the Federal Reserve's ongoing battle to contain inflation today, or at least in very, very recent history. So it's a really cool book, great idea for a book. And he's really synthesized a lot of other writing and research into one very readable place.
He's also a member of the editorial board of the Museum of American Finance, and he's a frequent writer for the museum's Financial History magazine.
Cool. I think that's good for an intro. I think people will enjoy this conversation. It starts with the historical perspective, and then we move on to alternative asset classes where Mark has some great thoughts and opinions, and then a little bit about his experience in institutional asset management.
Awesome. Okay, let's go to our conversation with Mark Higgins.
Mark Higgins, welcome to the Rational Reminder Podcast.
Thank you for having me, Ben and Cameron. I'm excited to participate. I followed you quite a bit online, and it's great to be part of the show. So thank you.
Yeah, super excited to be talking to you. All right, so to kick this off, Mark, how do you articulate the value of studying financial history?
So when COVID hit in March 2020, like everybody, I thought everything that was happening was completely unprecedented. we were quarantined, so I started reading financial history books. And the more I read, the more I realized that there's almost nothing that happens in financial markets that is unprecedented.
Hmm.
It just seems that way because nobody looks back far enough. And, I realized that the panic of March 2020 was much like the June 1914 panic when World War I came out of nowhere. Post-COVID inflation was like post-Great Influenza inflation. And, I began to appreciate, I used it with clients to mainly to calm them down and to give them a sense of what was happening and what could come. And I honestly think it's the most overlooked and most valuable asset that you can have as an advisor, as a consultant, as a just an individual investor. And it just continues to surprise me how overlooked it is.
Hmm.
What role has the U.S. financial system played in the success of the country?
I mean, it's been an absolutely critical. And I actually do have a quote that I want to read from the book. It's from Alexander Hamilton. And this was written, the thing about, there are a couple of people that stand out in history, and Alexander Hamilton was one of them. And in 1795, he said so many things that are relevant today, and I'll go through more of them throughout this interview, I think. But the one he said, this is in 1795, to describe the role of credit. He said, credit, public and private, is of the greatest consequence to every country. Of this, it might be emphatically called the invigorating principle. No well-informed man can cast a retrospective eye over the progress of the United States from the infancy to the present period without being convinced that they owe in a great degree to the fostering influence of credit their present mature growth. At the simplest level, having a financial system that can allocate resources to people that don't necessarily have the resources but have great ideas is a tremendous innovation. I mean, think about it. Before you had sophisticated financial systems, people who had wealth, it was up to them to innovate.
Mm.
But imagine a system where they're all of the great ideas that are out there with people who don't have resources, having access to that is absolutely critical. And that's what the US financial system has done.
Hmm. I'm curious what makes Alexander Hamilton stand out as a character.
He was just so ahead of his time in terms of foreseeing the challenges that the United States would have.
Hmm.
And if you rewound back to the reason I started the book in 1790 is if you rewind back to that, the United States was bankrupt. And some congressmen were kind of fine with that. But Alexander Hamilton realized that in order to have a functioning nation and to protect the nation from periodic public dangers, mainly war, you needed to have sound credit to fund it. And that we almost lost the Revolutionary War. And one of the reasons was we couldn't fund, we
Hmm.
didn't have the same financial resources as the British did. And he saw that as a fundamental requirement for a stable nation. And I honestly don't think the United States would be probably around, certainly not in its current form, if not for Alexander Hamilton's vision.
Wow. So that suggests, I guess, that the credit worthiness of U.S. government debt has been historically quite important. Is that accurate?
Absolutely, and it's unappreciated. And
Huh.
before this call, you sent a few questions, and one of them was, what was the biggest surprise in when I was doing this research? And the biggest surprise was we did not always operate with chronic fiscal deficits. We've been doing it for so long
Hmm.
that people think that that's kind of the norm for the United States. It was not. And that goes back to two principles that Alexander Hamilton established when he repaired the financial system of the country. And the first one was that you should primarily use the debt during times of emergency, mainly war. And we did that. And then pay it back when the public danger subsides. And we did that with the War of 1812, the Civil War, the World War One, World War Two, and then we kind of started paying it back after World War Two, and then stopped because we were we were basically emboldened by the tremendous post-World War II wealth that we had and the fact that we had the new dominant reserve currency. So what worries me now, and I've been talking a lot about this, is that debt levels are higher than they've ever been, even at the peak of World War II, right after the end of World War II. And most people don't appreciate the danger. And the danger is not necessarily, although it is to some degree, that we're just gradually going to exhaust our debt capacity. The danger is that we have eroded our debt capacity so much so that if there is an expensive, unexpected public danger, we may not be able to fund an adequate response. And
Mm.
most people don't, it seems like almost nobody appreciates that. And probably because it's been so long since we've really had to deal with something like that.
That's like a COVID version 2 or something like that. Some
Yeah, I mean,
major
we've
event.
always been able to fund it, but we're exhausting that supply. And
Huh.
the real anomaly is not it I mean, COVID, I think we went too far. I would argue we went too far with fiscal stimulus, but the global financial crisis, that is an appropriate usage of it.
Right.
Yeah.
It's the fact that we weren't paying back during benign times and generating consistent surpluses to rebuild the debt capacity of the nation, and it's a big concern.
Hmm.
Can you expand on that? Like based on history, how concerning are these debt levels?
It is hard to tell because there aren't that many precedents. So
Hmm.
the the comparables to the United States, I guess in recent times are, if you can call it recent, the British Empire losing their reserve currency, their dominant reserve currency status it eroded in World War One, and then they lost it after World War Two. And then before that, the Dutch guilder in the late 1700s when they lost the Fourth Anglo-Dutch War. So, the consequences aren't necessarily that a nation completely implodes, but it does lose its global influence and power. And I was giving a presentation, and pretty senior person at the Federal Reserve Board was talking, and they were calming things down that the United States is exceptional. We're such a large percentage of GDP. We're the innovation engine. And I'm just thinking to myself, well, my guess is the Dutch and the British said the same thing before they lost it. That shouldn't necessarily give us comfort. Now, I don't think it happened. Well, I mean, I don't think it doesn't happen often that a country like the United States loses its reserve currency status, but we're vulnerable by running up debt like this.
Hmm. Kind of related to that, how impactful has a central bank or the lack thereof been throughout U.S. financial market history?
Well, it's interesting. Most people don't realize that the Federal Reserve is the third central bank. So Alexander Hamilton established the first central bank. That was part of the financial programs that he formed in 1790, and the bank got its charter in 1791. Then it was a 20-year charter, and Congress didn't renew it barely by one vote. And so we went for a period of time, I think it was about 5 years in the mid 1800 or the mid 1810s, without a central bank. It was a disaster. Then we established a second bank. That was the famous bank war with Andrew Jackson. And then we went a long time, let's see, I think about 80 years without a central bank. And
Hmm.
the key thing that people don't realize is that there are several functions of a central bank. One of them is stabilizing the currency. People are kind of unfamiliar with that when you don't have a central bank and a bunch of other banks are just issuing notes denominated in dollars, they're not necessarily worth dollars. And when you have a central bank, a dollar is worth a dollar. So that's one thing. The other thing is central banks are critical as a lender of last resort. So when you have a panic, it can accelerate very quickly. When we think about banks, they have deposits, but most of their investments are in, relatively illiquid loans. And if everybody wants their money back at the same time, they basically go under. And what a central bank serves as a failsafe by buying those assets, providing them with cash during a crisis and stemming a crisis. So long story short, when we haven't had a central bank for those periods of time, those 80 years after between the Federal Reserve and the second bank, and those 5 years between the first bank and the second bank, manias are more common, panics are more common, depressions are more severe and common, and people don't appreciate it because we haven't seen a time like that for a very long time.
Do you have some examples of what happens, historically speaking, when banking is unregulated?
So banks are just, they'll keep leveraging their balance sheets generally until they get in trouble. Not all of them, but there's definitely a tendency to do that. And so when you didn't have a central bank, for example, in the 1830s, you had a lot of what they're called state chartered banks. They weren't very regulated. The way it would work back then is you would essentially have gold and silver as the reserves of the bank, and then they
Mhm.
would issue notes and you could redeem it for gold and silver. And they would just keep, issuing notes at higher and higher ratios to the underlying gold and silver. Then when there was some type of high demand to redeem the notes for gold and silver, and there wasn't enough, banks would go bust, and that was very common, and it was contagious too. So, one bank goes bust, and everyone's like, "Well, maybe my bank's going to go bust," and it's a contagion, and that's why you saw some very disruptive depressions when you didn't have a central bank to stop it.
Is that the what's it called? The wildcat banking era?
Yeah, that was the
Yeah.
wildcat banking, and really, I mean, it kind of stopped. The worst period was in the late 1830s and 1840s.
Huh.
But that's another thing that it's another thing with financial history that you think that the Great Depression, most people think the Great Depression was like kind of the singular event in U.S. financial history. You had many. I would argue there are two Great Depression level events in the 1800s. Some people would say three.
Hmm.
Um, but at a minimum, after the Panic of 1819, just devastating depression. After the Panic of 1837, devastating depression. Some would argue the 1840s were just as late 1830s and 1840s were just as bad as the 1930s.
Wow.
And at a minimum, um, the they were comparable, particularly the late 1830s and 1840s. One thing that's amazing is while technically the federal government has never defaulted, 8 states and one territory, Florida was a territory at the time,
Hmm.
did default after the Panic of 1837. So, I mean, that's how bad it was.
Oh,
Wow. Are there common themes like of causes and things like that for those big depressions?
It was real estate speculation, and um, I mean, it was real estate speculation in the 1830s.
Okay.
And again, it was the wheels came off in terms of lending practices
Hmm.
when Andrew Jackson essentially killed the second bank. And in the 1810s, it was also real estate speculation. That was a little different because it was another interesting thing is natural disasters often relate to financial crises more than people think. So
Hmm.
the in 1815, Mount Tambora erupted and actually cooled the earth for a couple of years.
Hmm.
That caused crop failures in Europe more than in the United States. So
Hmm.
wheat prices and cotton prices skyrocketed. So then everybody well, not everybody, but a lot of farmers in the United States started aggressively buying land in the Midwest for farmland. When global temperatures recovered, and there was a glut of wheat and cotton. Prices collapsed. People have leveraged themselves, irresponsibly, and
sure.
that's what led to the Panic of 1819 and the Depression that followed.
Yeah, that's fascinating. Definitely not like common knowledge.
No, but it's similar dynamics that you see. I mean, you see the same, very similar things over and over.
Huh. That's so funny. I loved your opening comment, and we were just kind of talking about it too, about how we talk about things being unprecedented, but they rarely are. Can you talk
Hmm.
about how common extreme market events, I guess maybe depends on how you define extreme, but extreme market events like big stock market crashes and big asset price bubbles, how common are those throughout history?
More, they're not that common, but they're more common than people think. And they've been less common over the past 100 years, really since the Depression,
Hmm.
just because we've grown more knowledgeable on how to stop them before they become problematic. We have, some of the worst panics, like in the 1840s, you didn't have a central bank, so you didn't have a lot of the fail safes that we have today. But it's more common than people think. And one of the most dangerous things is when people don't think it's possible anymore. And the more distant you get from an event, the more likely it's going to happen again. And, that's what makes me very concerned about some of the things that are happening in private markets right now. I think, I shudder to say this, but it concerns me more than crypto
Hmm.
because nobody believes it's possible.
Hmm.
It just seems universally accepted that private markets will help diversify your portfolio, will add to your returns, when a lot of evidence says that's not true. But even if it was true, that attracts so much capital that it becomes untrue. And
Yeah.
it's very concerning.
Hmm.
What are the early warning signs of a bubble?
You know, the bubbles are so hard to predict, and anybody that says they see one, it's a pretty bold call because you never really know. But like I said, I think that one of the biggest warnings is massive amounts of capital moving into an area where nobody thinks it can happen.
Hmm.
And that seems to be happening in private capital right now, even more than crypto. I mean, there are a lot of crypto skeptics. There aren't that many private market skeptics that I've seen. There are
Hmm.
some, but not a lot.
Hmm.
The other thing that became there's always a supply chain. The reason one of the reasons why these things are hard to see is because most people are occupying one segment of the supply chain and they don't see how the whole supply chain works. You saw this the during the global financial crisis with the way mortgages were originated, then passed on to investment banks, which packaged them into new products, which sold them into uh, to institutional investors, and everybody had an incentive to keep the supply chain going, and they didn't. Yeah, they probably each chain probably thought what they're doing is probably not the best thing, but they didn't see the systemic problem with it. And that's another thing that seems to be happening with private markets right now. You have a lot of capital that has gone in there over 25 years now with institutional investors. You have staff of pension funds that specialize in this, so their career really depends on continuing it. You have consultants that the more complexity they add to a portfolio, the more they're needed, the more fees they can charge. Advisors, same thing. And it just gets passed along the chain. And nobody realizes how dangerous the stuff is that comes out on the other end. And I see that with private markets right now.
Hmm. How prominent, looking through all of U.S. history, has just that type of speculation been, where people are bidding up some asset class to ridiculous prices?
I don't know. I mean, I wouldn't know how to put a number on it, but I guess in your working life, expect to see a couple, maybe.
Right.
I think the dot-com qualified, although that was much more compartmentalized. I think the global financial crisis was especially dangerous just because
Hmm.
it reminded me, people compared it to the 1930s. It actually reminded me more of the Panic of 1907,
Hmm.
where you had this huge shadow banking system that was outside the visibility and protection of the Fed, and it collapsed. And that was especially dangerous. It's very similar to what happened with the trusts in the Panic of 1907. And that would have caused we barely dodged a depression there. If it weren't
Hmm.
for J. Pierpont Morgan really organizing a private rescue. And there's one quote that's what led to the return of the central bank was we barely dodged a bullet there,
Hmm.
and that created enough pressure in Congress to bring back a central bank. But
Wow.
it's hard to tell frequency. But in terms of, I'm getting uncomfortable with how distant the speculation in the early 2000s is from today. Um, People haven't seen a major crash in a while, and I don't try to time these things, but there's kind of in the back of my mind kind of a bad feeling right now.
Hmm.
What historical parallels are there for crypto or even meme stocks?
Crypto's a weird one where it, the periodic table is pretty constrained, and to the extent that I don't know. I don't know the software behind it, but to the extent that they really have created something that can't be hacked, that is a scarce resource, it is unique. Now, do you really need another gold? I mean, I don't know. And my gut, I mean, I joke with everybody that if I buy if I ever buy any cryptocurrency, sell everything you have because there's nobody left behind me. I would never buy it. I don't see the long-term need for it. Could I be wrong? Sure, but I just get the feeling that it's more based on speculation than need. And an asset like that, I would never buy. But it is unique in the sense that if it is legitimately a digital form of gold, um, I haven't. When's the last time someone discovered something on the periodic table that could be used as a replacement for gold? That's not really possible. So, but I think it's more. My gut is it's more speculation than value. And so the meme stock thing, that's not unique at all. So that's basically a loophole in doing a stock pool. So before the Securities Exchange Act of 1934, which outlawed market manipulation, the way you made a lot of money on Wall Street was manipulating the market. You basically you'd have a stock pool that would use put false stories in the press and bull up the stock, and then the stock pool would get out. It was just all kinds of stuff. And the Gilded Age is even worse. There's some pretty funny stories back then. But so a meme stock is basically it. To me, it's collusion in that, whatever that guy's name was, Roaring Kitty or whatever, he knew that when he announced he was taking a position, everyone was going to blow up the stock. But to me, that is a loophole on market manipulation. Was it illegal? Technically, probably not. But was it in spirit a stock pool? I would argue yes. And so that was not unique at all.
Yeah, it's really interesting. That was their little tagline. We like the stock. They just said,
Yeah,
"Oh,
I
we
mean
like the stock.
that's
We're not manipulating the market."
and I will say allegedly because so I got to believe, I assume that he knew exactly what he was doing. That he knew if he posted that the market would go up, and I don't know. That to me doesn't strike me as very different from market manipulation.
Hmm. Yeah, that is a very interesting parallel, and it lines up very closely.
Yeah.
Can you talk about the historical origins of the many flawed practices that are still so common in the investment industry today?
Um, well, I mean, you probably have to go back millions of years. I'm not an evolutionary biologist, but I often, which ones specifically are you talking about, I guess?
Yeah, I mean, market timing, the prevalence of active management, over trading, all that kind of stuff.
Yeah, I mean, the active management. So the interesting thing, and this again, like when you study a couple hundred years, you start seeing big currents don't change that often. So you miss them, but if you're just living in the moment. And the active management, so if you go back to the Gilded Age and even the early 1900s, before the Securities Exchange Act, the way you really made money on Wall Street is market manipulation, insider trading, and if you can get away with it, securities fraud. And that changed with the Securities Act of 1933 and the Securities Exchange Act of 1934. So, I mean, you could still manipulate the market, but you were taking legal risks. So that really marked the beginning of the securities analyst. And it's not a coincidence that Ben Graham published securities analysis and it was so popular in 1934 because that you needed a new way
Hmm.
to make money on Wall Street. So that was really the birth of active management. And what is interesting is it didn't take long before it was clear, it's probably clear to the market manipulators before the Securities Exchange Act that it was really hard because there's so many smart people all looking at the same public information. It's very hard to figure out something that is different and right in a way that is better than everybody else. And there's a mathematical principle on this. Francis Galton discovered it actually in 1907, where there's this contest at a farm in Great Britain where a bunch of people were guessing the weight of an ox, and he found that the average guess was actually pretty darn close to the actual weight and was much better than I think it was like 90% of the individual guesses. It's the same thing with stock market. You have so many people looking at securities, it's very hard to figure out a you know a good value for that security that's better than the average. And But most people don't accept that. There's a study produced in 1940 by the SEC that showed it, and it's been that those observations are repeated every year by things like studies by S&P Global, Morningstar, but there's a whole industry built around it, and they don't want to accept that. So that's one flaw that persists.
Hmm.
Incredible.
I think Ben Graham even in I don't know if it was a later edition of his book. I know it was the first one, but at some point he did write that buying a cross section of all stocks might actually be a pretty good
Oh yeah,
strategy.
he did.
Yeah,
He knew the game. There's a quote on my wall from Ben Graham where he basically said, "You can't outperform the market as a group to
right,
financial analysts because effectively you are the market."
right.
And so yeah, he realized the game was kind of up.
Yeah.
What do you think are the most important lessons from U.S. financial history for people who are making financial decisions today?
I mean, I think what I tell people is the most important lesson is you cannot, almost nobody can outwit the market. And both in terms of timing or security selection. So the best approach is to have an allocation that makes sense for your time horizon. I'm assuming here that it's a long time horizon, but if it's a short
Yeah.
time horizon, you can't take as much risk. And um, use low cost index funds for implementation, unless you are a very rare breed, and almost everybody isn't. And rebalance as markets get as the market returns cause that allocation to deviate, and don't react to things that are fleeting. And that's something that one of the great values of going, I basically read my way to the present. So I started in 1790. I would read until I felt like I understood what happened, you know, at a high level during that period. And I just kept reading to the present. And you just start appreciating that most of the stuff, and I would read newspapers around major events, like I'd spend a weekend and read newspapers for like a couple of years, selecting a week or, one newspaper a week or something like that. And you just start realizing that most of the stuff is noise. And the big changes don't happen often. Almost everything you read in the newspaper is noise. It's going to disappear and be forgotten very soon.
Hmm.
And you just don't react to it. Most people are much too reactive to what amounts to noise.
Hmm. Yeah.
And I'm convinced it's because we of our memory. We think things are unique when they're not.
Yeah, no, that's such an important insight. I love
Yeah.
that. What um what lessons from history do you think, and this is I'm asking you to speculate here, do you think that the US financial system is going to have to relearn or is going to end up relearning the hard way?
Yeah. I mean, the question is where. I mean, we relearn the same lessons constantly. I mean, I
Yeah.
think what's happening in private markets is not unique, and unless there's something I'm missing, it's going to collapse in sort of a unique way, but not as unique as people think. A lot of people are going to get burned, and another thing that'll probably happen is some regulations will get created that are intended to solve the problem, and to some extent they might, but then they're going to cause a new problem, and that happens a lot. And I mean, it's actually, well, we can talk about it later with the one day gains, but yeah, I mean, we constantly relearn lessons, and it's such a tragedy because it's not necessary,
Mm,
and but it just seems the way we operate. Now, so I mean, we've also that's the pessimistic. We also actually have learned a lot, and that's something that often gets taken for granted. We're not doing complete wildcat banking, and we're not missing a central bank. State banks issuing currency that depreciate as you get further from the bank is not happening anymore. So, we have learned a lot, but it's kind of like, one step forward, two steps back, or what is that? Two steps forward, one step back, two steps, it's kind of that kind of thing.
I don't know, man. Maybe we kind of are redoing all that stuff with the whole crypto ecosystem. That's like its own version of
Yeah,
wildcat
that's
banking.
that's worrisome. I would not invest in that.
It's like the regulations have gotten better, so people were like, "Well, let's just create a new thing that's not regulated."
Well, especially the decentralized banking. I mean, that has been tried before. If you look at the state charter banks in the 1800s that were, effectively issuing their own currency, and I do see similarities between decentralized banking now and the state charter, the wildcat or free banking era in the early 1800s. So yeah, that's I don't see how that's stable. I mean, I, we already saw some of them blow up, and I expect to see more.
Yeah. Yeah, interesting. Yep, got to keep relearning lessons the hard way, I guess.
Yeah,
Um, all right, I want to talk more about alternative asset classes. How long have the big alts that we're seeing today, how long have those asset classes been around?
it's like I mean it's longer than 45 years, but I would say that the trend really started 45 years ago with in the 1970s you had it was the age of computing was really getting going, and they were a lot of these companies were having trouble getting well, the venture capital firms that were funding them that were having trouble raising capital. And one of the reasons was the trustees at pension funds and insurance companies, they were worried about the Department of Labor's interpretation of the prudent man rule, which essentially prevented them from investing anything that had a high likelihood of major loss. And the National Venture Capital Association had a big lobbying effort to change that interpretation. It was successful in 1979. And then you saw a flood of capital going to venture capital and also buyout funds, which there was a unique opportunity for a variety of reasons, which I write about in the book, to do buyouts, and they had the wind at their back, and so it really took off in the 1980s. That happened to be David Swenson joined the Yale University Endowment in 1985. They were early investors in both buyouts and venture capital. They did extremely well. And then in 2000, he wrote Pioneering Portfolio Management, which shared his strategy. It didn't say this, but people interpret it as, well, if we just allocate to alternatives, we're gonna get Yale-like returns. So
Right.
then that really triggered that really accelerated the flood into things like private equity or called buyout funds, venture capital, now private credit, hedge funds, and it has just increased a massive amount over the past 25 years. And now the latest trend um, is bringing it to retail investors, and that even in 401ks, and it's really concerning.
So why has so much been allocated to alternatives in recent history?
So, again, I think that the trigger was the people chasing Yale-like returns. And but now you have a situation where you have consulting firms that can increase their fees and kind of entrench themselves with organizations by making portfolios more complex. Now, do they do this consciously? Some probably do, but a lot of it's just subconscious. You have staff at major pension funds and endowments and foundations whose entire career is built on running an alternatives portfolio. So the bottom line, this is the danger of it. You have this kind of misperception that just allocating to alternatives is going to get you better returns and better diversification. And there's a lot of evidence, by the way, that that's not true. But even if it was true, the more funds you shove into the sector, the less likely it's going to be true in the future. And so the incentives are not aligned with stopping this.
That makes
It's
sense.
that
Like, it's like,
simple. It's funny. You see, oh, another thing, by the way, is academia. It's made me more skeptical of academia. So you see
Hmm.
these very complex studies that will say how alternatives have increase risk-adjusted returns, and they use different time periods, and it's very they get into minutia and miss the big picture. And the big picture is when you have a massive amount of capital moving into a certain sector, I don't even care what the past returns look like at some point. The future returns are not going to look the same. And so you have all these studies evaluating minutia in the past that is no longer applicable. I think that's a danger too.
Totally. It's a simple equilibrium effect. If an
Yeah,
asset class is
yeah.
that good, then people are going to invest in it up until the point until it's not that good anymore, other than the risk that you're taking.
Yeah, yeah. And all of the academic studies, first of all, I think my interpretation of them is that I don't even think they're giving the right message to begin with, but even if they were, it's not applicable anymore.
Right.
Hmm.
Yeah, no, it's a
Yeah.
super interesting perspective. I tend to agree with you. Um, Related to this, and this this drives me crazy because I've experienced it firsthand. Can you talk about how modern portfolio theory is abused in the promotion of alternative investments?
Yeah, I mean, so I gave a talk at CFA Live in April or March or April. And it was basically arguing that private credit it's just the next one. It's flooded with too much capital, and people are going to be disappointed. Most people are going to be disappointed. And it was funny, like one of I went over a bunch of red flags, and one of them was there's standing room only in the room, which in and of itself is a red flag that everyone's looking at the same thing. But
Wow.
more importantly, so I looked at this company called Horizon Actuarial Services, does like an average of long-term assumptions for for different asset classes. They survey, I don't know what it is, 20 to 40 or something like that, consulting firms and advisory firms. And what's interesting is you have the amount of money going into private credit is accelerating, yet the long-term expectations are also going up while the amount of over the past 5 years, the assumptions for the long-term return, like a 20-year return for private credit, have consistently gone up when the amount of capital is skyrocketing, which you should see the opposite effect, right? I mean, as the amount of capital goes in, you should see future expectations going down. So long story short is, and having worked at a consulting firm and seeing how this works is, oh, the other thing is, so there were the two largest allocators to private credit. I don't know if it still is, but at the time of the speech, it was for the prior 6 months were Makita, a company called Makita and RVK, where I used to work. And their assumptions continued, consistently went up, especially Makita, over the past 5 years. Is it that they're doing something unique, or is it that they're driving all these allocations simply because they've made a return assumption that is higher than
Hmm.
everybody else? So that's the way it's abused. These models are very imprecise. They're useful to visualize the risk return trade-off, mainly between equity and fixed income. But beyond that, they're not precise. And the danger is that you can literally drive massive amounts of capital just by raising an input that I mean, well within the margin of error, and drive capital into areas that you shouldn't. And it's not, in general, it is used well beyond its intended purpose.
I would also throw in like the expected return piece for sure, but then you've also got modeling like low correlations with public assets, which
Yeah.
just further exacerbates all
Yeah,
these
it's
issues.
just
But
it's little more than guesswork marketed as science.
yeah,
What do you think about the quote evergreen funds that many private equity managers are launching?
This is um I always marvel at how when Wall Street sees, it's like dumping, when there's a loophole, it's like watching a helicopter shove a huge load of $100 bills over Wall Street and just watching what happens. And that is what is happening with these evergreen funds. So in 2009, there's this kind of obscure valuation guideline called ASCA 20, issued by the FASB. And at the time, secondary transactions were very uncommon. So if you were an LP in a private equity or venture capital fund, you didn't you usually held it until the life was over. Selling those on the secondary market was very rare. There were about 10 billion in secondary transactions in 2009. And one of the problems, usually they were traded around among different pension plans and foundations and endowments. And just as a practical, it's called a practical expedient for reporting purposes. It was kind of hard if you bought one of these and you bought it 20% below the latest reported NAV, and the NAV keeps coming in different than how you bought it. It was kind of a pain for reporting purposes. So the FASB allowed you to it's called literally called a practical expedient, to, if you bought an LP interest for 20% below, or any percent below, you could immediately mark it back up to NAV just to make reporting simple. But the problem with that is you had a 1-day gain. But these things were kind of rare, and it didn't really move the needle that much. Well, fast forward 15 years, the number of secondary transactions has risen from 10 to about 160 billion last year, and it's expected to go up to 200 billion. But even more concerning is now, which was not true back then, you have these mutual fund, effectively closed-end funds, that are called evergreen funds, that are offering retail investors access to private markets. And one of the ways they're making them attractive is they're starting the fund by buying LP interests on the secondary market, immediately marking them up to the NAV, sometimes by 20, 30, 40%, reporting enormous returns, but they're based on markups that assume that the NAV is correct. It sounds complex. The analogy I use is, it's like if you saw on Zillow that a house was worth 1.3 million, you bought it for $1 million, probably because it's worth $1 million, and then immediately mark it up to 1.3 million and brag to all your friends that you just made 30%. That's essentially what's happening. And what makes it a fundamental structural flaw is that the only way to continue generating these returns is to keep buying incrementally larger amounts of secondaries. And that kind of formula, eventually you run into problems when the money runs out, and the money will run out because you have to keep buying incrementally larger amounts of money. The question is when. I don't know, but if there's a way for this to end well, I don't see it, period. I just don't see it.
Yeah, that's wild. I just want to walk through it to make sure it's clear for listeners, and then you tell me if this is right. So a private equity fund invests in some company, and usually private equity funds sell companies within kind of 3 to 5 years.
Mm-hmm.
And now they've created these evergreen funds that are buying on the secondary market. So a fund that's already been a
Yeah.
company that's already been purchased by another private equity fund. The evergreen fund is buying it from that private equity fund, and they're buying it below the NAV, which in a transaction you'd usually assume that is the price. But they're
Mm-hmm.
assuming that actually isn't the price. The NAV is the right price, and they're taking that difference between what they paid for it and the NAV they're marking it up to as an immediate return to the fund.
Correct.
And this is all kosher from the perspective of FASB, which is the accounting standards body in the U.S. for
Correct.
GAAP accounting. Yeah, that's
That's correct.
wild.
So the big bet is that the NAV, which there's a lot of evidence that these are inflated.
Right.
I mean, just look at the long queue to none of these private equity fund exits are really strained right now, at least at the prices that they're marking these assets to with the NAV. So there's a lot of evidence that not only is the discount probably the real value, it might be inflated now because you have so many secondary funds that are bidding on these assets to generate those initial markups to attract more investors. So there's actually an argument that the discount is above what they should be paying.
Yeah, that's
It's
wild.
pretty. Look, I mean, this is a loophole, and you see this a lot. This is just a loophole that's being exploited to the point of, at this point, absurdity.
So obviously this is going to boost the returns of the evergreen fund that's buying
Yeah.
the secondaries. But how big is this effect? Like if you go and look at these funds, what kind of returns are they showing
Oh, it's a
from
huge
these?
effect. I mean,
Huh.
if you look at, so especially initially, it gets less, which is the challenge. As they get bigger, you have to get
Right.
bigger and bigger chunks to make a difference because you already took the markup on the stuff that exists. But
Hmm.
um, I'd have to go into actual data, but there are some funds where almost all of the return is from within the first couple of years is from these secondary interests.
Wow.
When they buy an LP, they invest directly in a fund. It takes a long time to get a return if you get a good one at all. But so all of the returns in the first couple of years are coming from secondaries.
Hmm.
And to make matters worse, and this is where it gets really ugly. So a lot of these funds are paying themselves incentive fees on the performance based on largely on the 1 day gains. There's
Wow.
there's one case that was profiled in by Tim McGlynn and Jason Zweig at the Wall Street Journal. The Hamilton Lane Private Assets Fund just changed, and I don't know how in the world they convinced their investors to approve this, but somehow they did. And so they changed the way incentive fees were paid. They used to do it based on when the assets were sold. So, that, which makes sense, right? I mean, if you just
Mhm.
mark it up based on to the NAV, I mean, you don't know if that's real or not. Um, and so, it made sense if you realize those gains, then you pay the incentive fees. But they changed the rule so you could pay the incentive fees out just based on the markup. And I mean, think about that. So imagine if
Wow.
you got your friends to invest with you, you spent $1 million on a house that Zillow said was worth 1.3 million last week. You mark it up to 1.3 million and then pay yourself an incentive fee for getting a monster return. That's what's happening.
Yeah, that's crazy.
So what do you see as the biggest red flags in private markets today?
If I had to order them, I think the biggest one is no one believes a bubble is possible.
Mm.
And I don't. To be clear, I don't know if it's a bubble. To me, it's pretty obvious that I would never invest. The risk return is just so skewed. But no one believes. Like I said, in crypto, at least there's a lot of skeptics out there. There aren't many skeptics with these in private markets, and that alone is scary. You have the supply chain, you have the media. It's very difficult um, to convince the media that this is a problem. And especially the trade media. So when you think about it, the trade media is funded by a lot of these organizations with advertising. So it's there's very little skepticism, and the less skepticism that when you have very little skepticism with a massive capital inflow, that is very scary. And then just the stuff with the evergreen funds, the funny thing is it's almost like they have a bank run problem, but they've
Mm.
solved that by pushing all the risk on the investors. So a lot of these funds gate can
Right.
immediately. I mean, just based on they don't have to honor redemptions at all. But
Oh,
even their guidance is like if there's more than a 5% outflow, we can lock the fund and you can't get your money out. So it's almost like there's going to be a run on some of these funds eventually, even if it's not their fault. I mean, there were bank runs back in the 1800s because there's a big line at the grocery store next door. Like it may not even be their fault. And when that happens, they're just going to gate it and you're stuck there. And
Mm.
so it's like they solved the problem of a bank run by putting the risk on the depositors.
Man. Well, it probably goes without asking based on everything you just said, but what do you think the outcome is going to be if retail investors, which they've been having this stuff, I don't know if pushed on them is the right word, but they've been getting easier and easier access to it. And that's true both in the US and in
Yeah.
Canada. What do you think the outcome is if retail starts really taking up private assets?
I think people are going to be very disappointed with the returns, and they're going to be stuck in these things longer than they can imagine. I wouldn't touch these things with a 10-foot pole. I mean, I wouldn't go near them.
Hmm.
and the fees on them. It's funny. I remember, and I wrote about this actually in the book before I was aware of these things. Because I ended the book in March 2023, and this was kind of the early days of the evergreen funds. And I remember reading about the fees that they charged for investment companies in the 1920s and 1930s. And I was just like, this is ridiculous. They would have a commission, a load essentially of 7%. The annual fees would be, 1.5%. And missing something. There were also some other fees. But anyway, it amounted to like 5% a year for a lot of these funds. And I was thinking to myself, wow, I can't believe that happened. We'll never see those days again. Well, we have. You look at some of these evergreen funds, and with their management fee, with their incentive fee, there's an added cost to have it custody. Then you have the underlying fees of 2 and 20. I mean, you're talking 5 or 6%. Like, I don't know how you could possibly argue that paying that they're going to generate enough value over 5 or 6% a year to warrant investment. It's mind-boggling.
Yep. It's another case, I would say, of financial innovation benefiting the people creating the financial products more
Oh,
so than the people
yeah,
investing in them.
that's usually the way it works.
Yeah. Okay. So you work at IFA with Mark Hebner, who's been on this
Yep.
podcast in the past, and in your capacity there, you work with institutional clients.
Yes.
So I would love to
Also, a lot
know.
of high net worth too.
Okay, you work with high net worth too.
Yeah,
Okay.
both.
Okay. Good to know.
Yeah.
How often are you seeing institutions who have been sold alternatives?
Oh, I mean that's typical. Um, it's the that's the thing that always amazes me is there's so little skepticism about it that, and I think that the simple answer is they're just surrounded by consultants, by advisors, by staff, by the trade media, all saying the same thing.
Yeah.
And it's hard to dissuade them of that. And the funny thing about it is, um, it- the only trustees of institutions they're very resistant to doing something very different than the norm and the standard. So,
Yeah.
like if you go out on a limb and you get it wrong, there's a lot of reputational risk.
Yep.
The irony of that is if you're going to be like everybody else, then the only sensible way to go is to index everything, right? Because you have to, if you're going to outperform your peers, you have to be different, probably you most likely have to be early, and you have to be right. So if you're doing what everybody else is doing by allocating to, heavily to alternatives and in the same places, by definition, you're not early, definitely not different, and you're almost certainly wrong. So it's a
Ouch.
completely self-defeating strategy. And it's not that hard to see if you open yourself up to that possibility. If you're going to be like everybody else, the only sensible thing to do is to index. But it's hard to convince people.
So how strong has the uptake of index investing been in the
It's
institutional world?
easier to be honest with you, it's easier with high net worth.
Hmm.
And that's why I do have a sizable high net worth component now. But my background is an institutional, and I think it's desperately needed. But it's just a harder sell, and it takes longer too. So the high net worth can move relatively quickly.
Harder to
Yeah.
sell, really?
With institutions, yeah,
Yeah, really.
yeah. There's
Is it
like I said, it's a very different mentality, and on the smaller end, it's less hard. I mean, I highly doubt there'll be any uptake anytime soon with large public, pensions that, have billions of dollars. I mean, that is a really hard sell. On the smaller end, it's not as hard, but yeah, high net worth it's easier to
wow?
explain the rationale behind it. So
Yeah. I think the peer effects in with large institutions is just so strong because they look at
Yeah.
their, their investment committee down the road who also have alternatives and like, well, we can't get rid of alternatives if these guys still have them.
Yeah. And it's kind of, I believe, I strongly believe it's not a sound strategy, but it's hard to convince people.
I'm curious why do you think, and let me just tell you the premise first. You can tell me if you agree. I think the uptake of alternatives in general has been much stronger and happened much earlier with institutions, even smaller ones, than it has with retail. Do you agree with that observation?
Oh yeah, yeah. I
Why?
don't know.
Why?
That's a good question. I don't have as much experience on the retail side, probably because they didn't have the vehicles available, but now they have
Yeah,
the
okay.
evergreen funds, which
Yeah,
if I had to pick
that's probably
the
it. It's
worst possible vehicle to sell to a retail
yeah.
investor, that would be it. But probably that. I don't have as much familiarity with the history behind it though.
Okay, okay, okay. Yeah, no,
Yeah.
that's good. Um, so just on the topic of it being difficult to convince institutions, what do you find like if you're sitting down with an investment committee, telling them like, hey, index funds make a lot of sense, this alternative stuff is no good. What's the main pushback? What are the main challenges in talking about that?
There's not as much pushback. This is where you there's a disadvantage. So um, there's usually not that much pushback, but I know that there are plenty of academic studies that I would question, and consultants or other advisors using their expectations to say like, even if that is true, generally we've solved that problem, and they probably convince them. So it's hard for me to tell because I don't necessarily, you don't necessarily see the process going on. And to be clear, I have um, more than 100 million, and or if to make sure I'm correct, I don't know, it's right around 100 million. So call it almost 100 million or around 100 million in institutional assets. So it's not impossible. It's just I have a lot more high net worth in terms of assets under advisement or under management. I'm sorry.
Yeah, interesting. One of the most educational things that I've done in the last few years is joined an investment committee as a volunteer,
Hmm.
and just seeing kind of how that sausage is made and how decisions are made, and it's honestly absolutely fascinating.
Yeah.
And a
Yeah.
lot of it really is peer effects, like this is what everybody else is doing,
Yeah.
existing biases, advice from consultants,
Yeah.
but it's
So it's hard to crack that.
and it's diverse opinions too, because it's not like, you can't just convince one person, well, this is what we should do. Even if you do convince one, there might be other people who don't agree. And you mentioned these decisions with institutions taking a very long time. Like it's a very slow moving process.
the other thing about that I emphasize that is very important, but is often not seen in the present. And this is another thing that you see when you're doing it for long enough, is the greatest risk that investment committees have is the instability of their own governance.
Yeah.
So they're going to get replaced,
Yep.
let's say on average every 5 years. And every time there's turnover, there's risk that they're going to reverse things at an opportune time. And there's a lot of evidence that they do this. So by indexing, you're basically hedging governance instability, right? Because if you're constantly hiring active managers and firing active managers and there's turnover, there's a good chance that the new group's going to come in and be like, this manager's underperforming, this manager's underperforming. You're going to fire them at the wrong time. Then you're going to hire a manager that is outperforming and then repeat the cycle every 5 years. So that's actually something that's more of a risk with institutions than it is with individuals. And people don't often see it because they only look at their tenure. They don't see what's coming next.
Yeah. That's a super important point. Indexing does kind of solve that, but also every time you get turnover, like I've seen it where the new investment committee comes in and they don't want to do indexing anymore.
Yeah.
I think the ones I've seen that are super successful over long periods of time have a person or a small group of people who are like major advocates and
Yeah.
continuously convince everybody this is the right thing to be doing. But without that,
Yeah.
it's tough. It's tough.
But one thing that does help, so if you look at Nevada PERS, they've
Yep.
been almost entirely indexed for like 20 years now. It, I mean, the wind is at your back, especially over long periods of time.
Right.
Short periods of time, there's randomness involved here, but over long periods of time, now um, Steve Edmondson he's outperforming It depends on the time
True.
frame, but like
Yeah.
95% of his peers, that's before fees, and he has a
Yeah.
huge fee advantage. So, it's hard to argue to abandon indexing when you have performance like that.
Yeah, true. His story is so cool.
Yeah.
So the 60/40 isn't dead.
Well, it's not even that it's not 60/40 is yes, but like, that's assuming everyone has a risk profile. You can have a 70/30, an 80/20,
Yeah, I
a
know.
50/50. You don't have to necessarily have a 60/40. It depends on your risk profile.
No,
But
it's always
the indexing, the minimizing the cost through indexing and the risk of underperforming the market using active management is the more important point.
Yeah.
Our final question for you, Mark. How do you define success in your life?
So, well, on a professional level, I always look to Alexander Hamilton at a professional level, and he had a great quote that came from, I think it was 1782, August of 1782. It was kind of a bad period of the Revolutionary War, and he was dispatched to New York to report on economic conditions, and he told the Continental Congress exactly how bad things were. And he ended the letter, and you can see it online, with the statement that I always thought it my duty to exhibit things as they are, not as they ought to be. So, I believe that there is a market for truth. Not that I know it perfectly, but if I strive to tell it to the best of my ability, I think I'm doing something good that I can feel good about. So that's what guides me on a professional level. On a personal level, I have my personal values with my family, and I think just staying true to those. There's always your circumstances change, which there's a risk that can change your values, and always trying to stay as grounded as possible and not to change those values is something I strive for personally. So those two things.
Hmm. It's a great answer, and makes you a great fit for this podcast.
Oh, well, thanks.
I
Thanks.
thought I thought that was a great conversation, Mark. Thanks a lot.
Oh, thank you both for having me. I appreciate it. I hope this is helpful to people.
Yeah, great to see you. Thanks for coming on.